what really struck me is not just the rate increase. That was expected. But him talking about the economy. And the market's a discounting mechanism. So when you take, 2 bips, 20 bips off your GDP forecast, the market doesn't see that. What they see is that's the first stop. And the downslide will overshoot their estimate. So to me, that's been the worry in the market. That continues to be the worry in the market. And what we also have, frankly, are CEOs pulling back. So GDP growth has been driven by inventories. That has been in advance of tariffs or more tariffs. So what you've got now is potentially deflationary measures which will come into play because they'll have to pare down those inventories because they're too expensive. So I don't really see a catalyst to the upside. I hate to, look at emotion and say, hey, it's just an emotional, but it's not. I've been consistent this way for months and months. I've agreed with Mike. I don't think it's getting better anytime soon, and that's okay. Keep cash and buy when it gets cheap enough.
Rich Saperstein, I know that you've been fielding calls from your clients. Is there a belief that the Fed got it wrong? The market no longer trusts the Fed, as we ask at the very top of the show?
So I viewed yesterday's Fed policy decision as not being hawkish, but rather dovish, because right now we're going to have Fed funds between 240 and 250. The neutral rate is going to be somewhere around 275 and 3. So we've got 2 more tightenings in 2019, and they're done. I think the bigger issue that investors have to be concerned about is we don't have a playbook on quantitative tightening. And global central banks that for the last decade have been just massively accommodative, putting money in, are reversing the thrusters on that liquidity.
Okay, so the market clearly wanted one and done, one and wait, not 1 and 2. So I don't know how dovish, that message is. And to your point about the quantitative tightening, Jeffrey Gundlach, we sat with him the other day, tweets out yesterday, after the Fed decision, Powell made 2 mistakes, he said. Autopilot on QT, quantitative tightening, and too much talk about economic, quote-unquote, modeling. The stock bear growls on. Is that what happened?
100%. I think the problem has to do with the balance sheet. I think Jeffrey's right as it relates to QT. If you remember, we had Vinny Viella on the show, and he talked about markets in a heightened state of urgency. And the market is in a heightened state of urgency right now, and the liquidity is not there on the other side. Listen, a lot of people are placing blame, pointing fingers as to why we're seeing the elevated volatility, but you cannot dismiss the fact that the Federal Reserve went from expanding the balance sheet, buying risk assets, and they're now paring that back, and that is removing liquidity from the marketplace in a time of that heightened urgency.
All right, so Pete, NASDAQ down 20% from its intraday high on August 30th. That's bear market.
Yep.
Gundlach.
There's bear markets everywhere.
Bear market the other day. The S&P is down more than 4%, approaching 5%. Since that call just the other day.
Well, I think Steve mentioned that moving it up, I think, in the interest rate was something that was sort of forecast. We sort of, it came down in terms of how much did we think it was going to happen. But still, basically, the general idea was it's going to happen. They're going to raise a quarter point. It was what was said after that by Powell, I think. And the fact that he said 2 things that don't make sense to me. Well, one of them has to make sense. And then how do you say both? He said we're going to raise 2 times. We're lowering it from 3 to 2, but we're going to be data dependent. Why wouldn't you just say, we're going to be data dependent? I think that was part of the problem, too, Scott. I think the interpretation of that is that these guys they're still modeling. They're still using all these things that everybody's angry about. And I think that, along with liquidity, as Joe mentions, but volatility, we talked about this a while ago. When volatility was trading at 21, I said it was too cheap. It's still too cheap at 27. Given the numbers that we see every single day in this market, the ups and the downs, I'm not just talking about we finished the day down 250 or 300. I'm talking the intraday movement is absolutely outrageous to the point where I still think we see at least a 30 handle. Now, I know Gundlach said 40. 40 would be extreme. That would be that big whoosh that everybody's looking for, I think. But I think 30 is not completely out of the question. Clearly today at 28, 30 is just a couple of points away.
I don't know what people expect the Fed to do.
You know what? Maybe, Steve, I'm glad you bring that up. Maybe it's, stop your modeling and just start listening and watching and observing what's actually happening in the economy rather than some mumbo-jumbo economic model that you've been trained to put into the machine, and it spits out this thing that says you can raise now and you can raise 2 next year, and the world's going to be great.
But everybody comes on the show, everybody, and I'm sure we're going to hear it now, except for maybe some of us, and say, hey, the economy's great. Lee's going to talk. He talked before. Economy is great. look, we're growing GDP 3.5%, 4%. We just increased it again. So I don't know what people expect the Fed to do.
But the economy's slowing.
But here's why I say that. You've got employment at these low levels, right? You've got GDP, as I just said, 3.5 to 4, maybe coming down to 3 now in terms of what Leisman said the other day. Still fast, right? And so the Fed's supposed to look out. You can't have this Fed put all the time, because then you know what happens? It's always risk on. There's no penalty for putting capital to work. You've got to be able to moderate at some point. And this is the downside of massive quantitative easing and giving everybody a free lunch the whole time.
Brenda Vingiello, welcome back.
Thank you. I would agree with Gundlach, though, that when you hear a word like autopilot, nobody wants to think that the Fed is on autopilot in this environment, particularly when we've seen signs of a slowdown. Now, we don't think we're heading into a recession, but things are slowing a little bit. And so one would hope that the Fed would be a little more cognizant of that and take that into consideration rather than being on autopilot, particularly when it comes to the balance sheet. But that being said, valuations are getting really attractive here, we feel, in many cases, particularly for a lot of growth companies, that you really don't get opportunities like this typically without an operational misstep for many companies. So we think there are some buying opportunities that are starting to transpire here. Salesforce down 5% today. Company just reported a great quarter at the end of November. It was not that long ago that we got an update from management. So things are good. We continue to think that's a solid space to be in. Great growth companies are never going to be cheap, but when they're down double digits from the high or more, I think it creates an interesting buying opportunity.